Joining us now is Jacob Soneshine, markets reporter at Barron's, to help break down some of this red. Jobs numbers came out today, delayed November jobs report. The economy added 64,000 jobs, higher than expected. What are your takeaways?
Well, first of all, number one, we also lost roughly 100,000 jobs in October, and second of all, this is a very murky jobs report. The BLS right now is trying to get a feel for how to report the numbers and what the numbers actually are. So the jobs picture overall, I wouldn't look at how things changed incrementally today. The market did not make a lot of big moves. Probability for a Fed rate cut did not make a big move. The labor market is weak. We are getting Fed cuts, and we're getting a lot of money coming in from the Fed into the Treasury market. So this is supportive of the market.
All right. What do you think people should expect from the Fed in 2026?
Oh, I think the thing I just said is one of the most important things. They're going to cut unless you get inflation moving up to 3%. They've proven that, okay? Question on cuts is how many cuts, but I think the thing that really matters, because we'll get one cut, two cuts, worst case scenario maybe zero, I don't know. But I think what really matters right now is the Fed made clear, in fact, they said they're going to plow $40 billion monthly into short-term treasuries to keep those yields compressed down a little bit. So I think the Fed is making clear they're adding liquidity into the banking system. They're keeping rates low with as many tools as they can use, and that's going to support the economy and the financial markets.
Do you think a lot of these delayed data points that we're seeing coming out late because of the government shutdown, do you think they're going to have a big impact on the Fed's moves next year?
No, because I think at this point, all we're missing at this point is like a little bit of data here and there. We got October jobs, right? The data's going to have to be cleaned up. You're going to see revisions, and those revisions can be big. But at this point, we get it. We get the picture. If you're an equity investor, the rate of job growth is decelerating, is declining. Maybe you're losing jobs. Maybe we did lose 100,000 in October. So the point is that the labor market is weak, and that's good news because it means the Fed is going to be supportive. Meanwhile, at that point, you can expect economic growth to continue to be mild, which I do think means that you can expect the equity market to continue to do pretty well.
What risks are you monitoring right now in the market?
Well, everything I just said is a long-term risk that I'm actually kind of worried about for the state of the world, for the state of investors. So the Fed is really supportive, but you now have Oracle, which is a massive company, previously free cash flow generative, old massive software company, borrowing money. Netflix wants to borrow it's going to have to borrow tens of billions of dollars if it's going to buy Warner Brothers. You now have massive companies borrowing money to build out data centers, massive companies that used to not have to borrow all that money. My point is that the Fed is fostering an environment of risk-taking, and maybe, time will tell, excessive risk-taking. So if the data center situation turns out to be bubblish, that's a problem. And I could go on, but the Fed is fostering an environment that's good for stocks in the near term, but a little bit risky in the long term.
You mentioned some big players in the AI space. Some of our experts are saying they may be seeing an AI bubble. What is your take on the bubble?
Well, I said to a source on the phone today, and he agreed with me, hey, I think the data center situation everybody knows is a bubble, but what we don't know is when it's going to pop. Google said 2 years ago, we'd rather overinvest than underinvest. Everybody's got to invest to keep their technology up to par. And if you look at the rate of growth in data centers, it's absolutely explosive. One of these days, and I don't think it'll be in the next few quarters, Meta or Microsoft or Oracle is going to say, we are massively slowing down the rate of data center investment. When they do that, expected revenues for your NVIDIAs, your AMDs, your Broadcoms, that'll go way down. And I think at some point the data center situation bubble pops, but because I don't think it happens over the next few quarters, you got to stay invested in equities right now.
All right, Jacob Soneshine, markets reporter at Barron, thank you so much for joining us on Taking Stock.